Hi everyone. So today in this session we are going to continue with the remaining important basic discussion regarding the chapter IFM. So in the previous session technically we started with the concepts of basics in the basic rudimentary concepts of forex, like what are the markets, types of quotes from the exchange point of view, and what are the types of quotes from the banker point of view. What do you mean by ask rate, what do you mean by bid rate, and how to understand ask and bid rates. All the concepts we have clearly understood in the previous session. Now in the today's lecture what we are going to learn is the first point. So we are going to learn other concepts attached to the IFM concept, like understanding the concept of cross currency quotation, understanding the spot rate, swap points, forward rate. Okay, after that we are going to understand how to adjust the cross currency quotations in case of 2 currencies, in case of 3 currencies, in case of 4 currencies. And more than anything else, we are going to understand one very important concept called as appreciation and depreciation in foreign currency, also called as a premium discount concept. Premium and discount concept, how it actually works, everything let us try to understand in the given session. In this lecture we will be first completing out the basics. We will be first completing out what's the basics. Once the basics are completed, this video will be cut. After that we will continue with the next lecture. In that next lecture, advanced models on calculation of all the foreign exchange concepts we are going to do. Okay, so one by one we will complete each and every learning objective very clearly in detail. Clear? Let's start. See here. See here, up to 9th question we have completed in our previous class. Now we are going to do from 10 to 17. Okay, now 10. What is a cross currency quotation when it is used is a question. What is a cross currency quotation and when it is used is a question. Okay, now see here, what do you mean by a cross currency quotation? What really does it mean? Let us understand clearly. Okay, see here, I will write here, when two currencies are there. How many currencies? Two currencies are there. When there are two currencies, when these both currencies are not quoted against each other, then we can't express a foreign exchange itself. Two currencies, three currencies, four currencies. Say for example, there are two currencies, dollar and rupee. Both are traded against each other or not? Yes. If both are not traded against each other, a exchange can't be created. Exchange can't be what, sir? Created. If the exchange can't be created between two, how come the exports and imports happen between those two countries? That we need to understand first. Am I clear? So therefore, when two currencies are not quoted against each other, but individually each currency is quoted against one common third currency, this is a common currency. In that case, we can calculate cross currency quotation. We can calculate what? Cross currency quotation. So, so in a layman language, when two currencies are not quoted against each other, but both are quoted against one common currency, then we can calculate cross currency quotation, taking that common currency as a base currency. Common currency as what currency, sir? Base currency. Repetition for the last time. When two currencies are not quoted for each other, but individually both are traded against a common currency, then we calculate a quotation between two unquoted currencies called as cross currency quotation. Called as what quotation, sir? Cross currency quotation. So how this cross currency quotation will be calculated? Without currencies, taking A, B as an example, I will first tell you. Once completed, I will put currencies in that place. Once completed, I will put ask and bid in that place. Once that is completed, we will solve the problem. Okay. Then the basic concept what we learned will be having an application in a fair manner. See here. There is a currency called as A. There is a currency called as B. A and B are not quoted against each other. However, A and B are quoted against a common currency called as C. Or I can tell this way. There is a currency called as A. There is a currency called as C. Now, there is a base currency called as B. This particular currency called as B is a common currency with which A is getting traded, C is also getting traded. Using this B currency as a common base currency, we can calculate a cross currency quotation between A and C. How? I want how many A's are required to purchase one C equal to A is traded for B or not? A by B into B is traded for C or not? B by C. B and B cancels. In turn, it will give A by C or not? That is our agenda. So, therefore, when two currencies are not traded for each other, but individually both are quoted against a common currency, taking the common currency as a base currency, we can calculate the quotation for non-quoted currencies. This is how the concept of cross-currency quotation has been emerged in IFM. Okay. So, now let us take the currency amounts as a base. I want, one second, I will explain in a way. Rupee by dollar is traded. Rupee by dollar is traded. Dollar by pound is also traded. I don't want dollar by rupee or rupee by, I don't want rupee by dollar and dollar by pound. I don't want that. I want rupee by pound. I want rupee by pound. I went into the Forex market and searched for rupee pound. There is no quotation. Then how to do? How to do is, see here. How to do? See here. First, which currency you want? Rupee. Rupee is A. What is this currency? Pound. Note this as a C. Okay. Base currency, common currency will be there. Na? That's B. B means base currency. Base currency will become what? Dollar. Base currency will become what, sir? Dollar. Okay. Now what will happen? See here. Rupee A, pound C, B, dollar. Now how to understand this? See here. Just a minute. See here now. A by C equal to rupee by pound you want, not pound by rupee. Okay. A by C equal to A by B into B by C. Means how to write? A by B. A means rupee. Rupee by dollar into B means what? Dollar by pound. Rupee by dollar is getting traded or not? Yes. Dollar by pound is traded or not? Yes. Then you can calculate rupee per pound. This is how you can calculate a cross currency quotation. But in reality, how it actually apply, I will explain you with a problem. Not one problem. We will be doing 4 or 5 problems in this area. With that, you can really understand the concept clearly. Okay. 4 problems I have. 2 complicated problems and 2 basic problems. 2 basic problems we will do now itself. 2 complicated problems we will do in the next lecture. Now we are in basics. So learn basics only. Third one will be advanced concepts will come. 40 past exam questions we will do. 40 past exam. I have kept the PDF in my Telegram group or not? Check there. Each and every problem what I kept are all past examination questions only. Every single question, I am not talking about anyone. Every single question are given in one of the past examinations. Either past exams or RTP or MTP question. Repeated questions I didn't keep. Unrepeated questions and unique questions only I kept. 40 golden questions. Not even a single problem we can leave. Okay, let us begin. So, in the nutshell, what is a cross currency quotation? When two currencies are not quoted for each other, but both are individually quoted against one common currency, then we will calculate a quotation between two unquoted currency. That itself is called as a cross currency quotation. What it is? Cross currency quotation. Import and exports impact of cross currency we will do in one problem. And the second very important thing what we do here is arbitrage. What it is? Arbitrage. When these cross currency quotations are being made, we will also check an arbitrage concept. How this arbitrage actually works, we will also see. Okay, so let us first try to understand this concept with one or two basic examples. Once completed, we will be going into next concept. Basic problems once completed, comfortably we can do the advanced issues. Okay, see this. Calculate cross currency quotation on the following. 1 dm equal to, simple problem, 1 dm equal to $0.35. Okay, what is traded now? Dollar by dm is traded. Okay, next 1 ff equal to 0.31 dm means what is also getting traded? Dm by ff is also traded. I want dollar by ff. I want what's a dollar by ff. Okay, now I will write like this: dollar by dm traded, dm by ff traded. I want dollar and ff. Can I calculate or not? Okay, first notate the currencies. Dollar equal to, I want dollar by ff. Dollar equal to A, ff equal to C. Common currency dm will be the base currency B. Now tell me, A by C equal to A by B into B by C. Sorry, A by B into B by C. A by B, dollar by B means dm into what is B? Dm divided by C, ff. So dollar per dm, number of dollars per dm 0.35 into number of dms per ff 0.31. So 0.35 into 0.31, that gives you 1085, 0.1085. This will be $1 equal to 1 ff equal to French franc equal to $0.1085. This is how we can calculate the base notation calculations. Okay, this is a simple problem only. Next one will be with the dual quotations. There we can understand much more clearly in detail. Hope everyone understood the first problem clearly. Okay na? First you write the notes, theoretical notes first. After that you write down and copy down the other parts. Please write down the notes. When two currencies are not quoted each other but are quoted against a common currency, it is called as a cross currency quotation. Formula: let us say there are three currencies A, B and C. We want quotation between A and C, but they are not quoted against each other, but A and B are quoted and B and C are quoted. We use cross currency quotations as follows: A by C equal to A by B into B by C. Sir, with four currencies, A by D equal to A by B into B by C into C by D. Then B and C will all become base currencies. Okay. Okay. First, copy down the theoretical notes, everyone. Everyone copy down the theory notes. Problem number 11 also you can copy. Hope everyone completed copying the notes. Enough time taken. Okay, now let us go into the next problem. So we now completed question number 11 and the notes writing. Let's go to question 12. Let's see. Compute cross currency quotation on both ask and bid for dollar by pound. For dollar by pound. In the question, what they have given? Rupee by dollar given, rupee by pound given. Rupee became the base currency for them. We want pound by dollar, dollar by pound. We want dollar by pound. Okay. We want dollar by pound. Dollar will be A, pound will be C. That equal to B will be rupee. Dollar by, spell out everyone. Sir, Forex chapter you will become perfect only if you spell out and do on your own. Okay, tell me. A by C. C means what? Pound. A by C equal to A by B. B is what? Rupee into rupee by pound. This is the notation. Okay, rupee by pound. Now, answer my question clearly. See the question and tell me. Okay. Dollar by rupee means rupee is in denominator and dollar is in numerator. That means dollar by rupee, we want dollar by pound, means dollar by rupee into rupee by pound. But see the question now. We have been given rupee by dollar, dollar by rupee format. We have been given rupee by dollar format. But here we got a dollar by rupee. Therefore, we need to change it. Okay. How to change itself is a question. These confusions you will get in the examination hall, which should not come. Let us clear in the class itself. See here. We are asked to calculate both bid and ask. In the previous question, it is only a single quotation. Now this is a dual quotation. Two-way quotations are given. In this case, how to do? See here. Bid of, okay, A by C equal to bid of A by B into bid of B by C. Okay, bid of A by B into bid of B by C. Bid of A by B. Bid of, write down, bid of A by C means what? A means I want dollar, C means I want pound, B is rupee. Bid of dollar by rupee into bid of rupee by pound, B by C. Now listen carefully. We got bid of dollar by rupee. This is a dollar by rupee or rupee by dollar or rupee by dollar. But we want bid of dollar by rupee. Bid of rupee by dollar is given, but we want bid of dollar by rupee. How to calculate? 1 by, yesterday I told you na currency conversions. Ask of rupee by dollar. 1 by ask of rupee by dollar. 1 by ask of rupee by dollar. Simply, I want, this is, say for example, rupee is A, dollar is B. Not cross currency like A by B. Normally, I have A by B format, but I want B by A format. What to do? 1 by ask of A by B. Okay, so 1 by ask of rupee by dollar into in the given quotation, bid is given as a rupee by pound or not? Yes, it is already given rupee by pound. Therefore, you can write as bid of rupee by pound. So 1 by ask of rupee by dollar. 1 by ask of rupee by dollar means 47.62 into bid of rupee by pound means how much? 75.50. Take calculators. Take calculator everyone. 75.5 divided by 47.62. 1.5855. 1.5855. And what is this 1.5855? 1 pound equal to dollar. This is a bid rate. Now we need to calculate also for the ask rate. Just we need to make the following changes. Okay, see here. Ask of A by C equal to ask of A by B into ask of B by C. Means ask of A by B means dollar by pound. A by C means all dollar by pound. So ask of dollar by rupee into ask of rupee by pound. You have to write notations clearly in exam. Ask of, you write, then that half mark will come. Don't presume anything. Okay, we require dollar by rupee format, but given is rupee by dollar format. What to do? Inverse it. Okay, so ask of dollar by rupee can also be written as 1 by bid of rupee by dollar. So instead of this, 1 by bid of rupee by dollar into change it. Okay, ask of rupee by pound. Now let us calculate this. Let us calculate this. 1 by bid of rupee by dollar means how much? 47.50 into ask of rupee by pound 75.60. 75.6 divided by 47.5. How much? $1.5916. 5916. So bid is lower, ask is higher. This is how you have to calculate the cross currency quotation. So summarize everything. Whenever you are calculating cross currency quotation, in examination don't expect single quotation. For understanding sake, as a basic question I have given this, but in reality they will ask you dual quotations in examination. Dual quotations in what, sir? Examination. At that time you have to calculate cross currency for bid as well as cross currency for ask. In the process of calculating this, sometimes quotation will be in one format, answer we require will be in another format. At that time you should be very keen enough to evaluate. At that time that conversion formulas what I have given will be useful. At most important formulae whatever you learnt in the yesterday's class. Conversion, direct quote into indirect, indirect into direct using formula approach. Means what? Ask of A by B equal to 1 by bid of B by A. So we want here ask of dollar by rupee, but in the quotation they have given rupee by dollar. Means how to do that? Instead of writing ask of dollar by rupee, I can write the same as 1 by bid of rupee by dollar. Through that we can calculate the rates. Clear everyone? That's very important to understand this particular basic concept. Okay, so please copy down these notes. Question number 12. First I will show you the answer how I have given. See here. Given quotation, $1 equal to 47.50 dash 47.62. 1 pound equal to rupees 75.5 dash 75.60. We require $1 equal to bid how many pounds, ask how many pounds. See there. Cross currency between pound by dollar. Pound is cross currency between pound by dollar. Okay. Cross currency between dollar. Cross currency between dollar by pound. Cross currency between dollar by pound. So please copy down. So by mistake here I have written $1 equal to pound. Sorry, 1 pound equal to dollars how much and dollars how much. Okay. So the given quotation, if you observe, we want dollar by pound format. Dollar by pound, that means how many dollars per pound. Okay, how many dollars per pound means we require 1 pound equal to how many dollars bid, how many dollars ask. Okay, see here, 1 pound equal to how many dollars bid, how many dollars ask. Okay, see here. So technically we have to calculate the cross currency quotation. What quotations are? Cross currency quotation. So cross currency quotation between dollar by pound equal to dollar equal to A, okay, pound equal to C, and rupee equal to B. So bid of dollar by pound equal to bid of dollar by rupee into bid of rupee by pound. Bid of dollar by rupee can be written as 1 by ask of rupee by dollar. Bid of rupee by dollar we can do directly. Here if you observe, two currencies which are not quoted together are dollar and pound, but they are quoted together on a common currency called as a rupee. So bid of A by C equal to bid of A by B into B by A into B by C. So we can calculate a cross currency between dollar and pound. So this is the point. Okay, so this is the value that we obtain. So finally do this, copy down the solution. So hope you completed writing. So this is how the cross currency quotations has to be calculated when there are two currencies. Two currencies means, I mean, two-way quotational currencies. With three total currencies we want to calculate against two. This is how we can do. Now let us do a question also on four currencies. Means we are not going to just to do with the three currencies now. If four currencies come, instead of writing as A by C, we will write it as A by D. We will write it as what? A by D. How that look like, how that concept will be, let us see in problem number 13. Take question number 13, everyone. Take question number 13. See here. Just a minute. Okay, see here now. Given the following quotes, at what rate you can negotiate to buy the yens against rupee? Okay, we want quotation between Rupee and yen. Okay, rupee yen are traded traded against each other or not? Let us check. This is rupee pound, rupee by pound. This is dollar by pound. This is rupee by pound. This is dollar by pound. This is yen by dollar. Okay, this is yen by dollar. We want rupee by yen, which is not quoted. Now the question is very clear. Now the question is very clear. Rupee by pound, sorry, rupee by yen is not traded each other, but rupee by yen is not traded against each other, but both are traded against, okay, but both are traded against one common currency. Rupee pound, dollar pound, and yen dollar. Here there is no one currency that is being involved. In this case, how to do? Repetition once again for your kind clarity. We want, okay, rupee yen format. We want what format, sir? Rupee yen format or yen by rupee format. You take whatever you want, but try to understand clearly. What quotation we want? Let us try to understand. See here. He clearly said, negotiate to buy yens. Negotiate to buy yens against rupee. So now let us understand which should come in denominator, which should come in numerator. You should only tell. I want to buy what? I want to buy yens. Okay, now listen. I am an Indian banker. I want to buy yens. Now repeat the answer. I want to buy yens. Bank has to sell yens. Bank sells at a higher rate. Higher rate will be the ask rate. Therefore, required quotation is ask of, I want to buy what? Yens. Okay, rupee. This is how the quotation should be. Ask of rupee by yen. This quotation institute will check in your answer sheet. You don't write this quotation. Directly you will make an answer. He will strike off and put it 0. Then you will apply for certified copies and make a complaint that I am not given with full marks, because who knows that you know this concept? You have to write it. You have to write it. If you don't write, I will presume that you copied somewhere. So therefore, don't assume anything in Forex. Write down in a stepwise format. That should come from the class itself. Okay. So ask of rupee by yen equal to, tell me, rupee by yen are quoted against each other, not quoted against each other, not quoted against each other. Okay. Now see here. Sir, question happens now. This will be A by D equal to A by B into B by C into C by D. We want A. A is rupee. N is D. Okay. N is D. Now we want A by D. A by D equal to A by B into B by C into C by D. This is the given one. Now the question arises, sir, I have to take, here there are two currencies. Pound is there, dollar is there. Yen dollar traded each other, pound dollar traded each other, rupee pound also traded each other. Now what I should take as A, what I should take as A, and what I should take as B is a question now. Always take that currency which comes in per unit for multiple times. I repeat, take B as that currency which get repeated multiple times in per unit side. Here if you observe, dollar pound traded each other. Okay, pound is in per unit. Pound and rupee is traded each other. Pound is in per unit. Okay, dollar and yen is traded. Here dollar is in per unit. Here dollar is in number of units. Therefore, ensure that which of the two currencies in dollar and pound, which of the two currencies is repeated for multiple times in denominator or per unit side, pound. Therefore, A equal to, we want what? Rupee. D equal to yen. B equal to pound. C equal to dollar. Okay. So now what will happen? A ask of rupee by yen equal to, everyone note it. Ask of rupee by yen equal to ask of rupee by A by B. B means what? Pound into ask of pound by, ask of pound by A by B into B by C, dollar into ask of dollar by C by D. What is a D? Yens. Okay. So now see the question. Ask of rupee by pound. Ask of rupee by pound. What is the ask of rupee by pound? Number of rupees per pound. Ask how much? 47.53 into ask of pound by dollar, ask of pound by dollar. Pound by dollar format la question is given, dollar by pound format la question is given, dollar by pound. Okay, so it is given in dollar by pound. We want pound by dollar. What to do? 1 by bid of dollar by pound. What is the bid of dollar by pound? 1.5200 into ask of dollar by euro. Ask of dollar by euro. It is given in dollar by yen. Dollar by yen format la question is given, yen by dollar format, yen by dollar. Again 1 by bid. Instead of writing ask of dollar by yen, we will write 1 by bid of yen by dollar. Okay, 123.50. Take calculator, everyone. Take calculator. Calculate 47.53 divided by 1.52 divided by 123.5. How much? 0.2532. 0.2532. What it is? 1 yen equal to rupees to 0.2532. At this rate, yen and rupee will get traded at a ask rate. Trade at what rate, sir? Ask rate. Now you may ask a question, sir. As you said, when 4 currencies are given, B should be taken as that currency which is repeated multiple times in denominator. If I don't take like that, what will happen? See here. Here we want rupee by yen format. Okay, ask. Because we want to buy yens, bank has to sell yens, bank sell yens at higher rate will be ask rate. Therefore required quotation will be ask of rupee by yen. That's what the calculation done, that the rate is also given. Now ask of rupee by yen equal to, if I take rupee as A, okay, yen as D, this is anyway common, dollar as B and pound as C, what will happen? Let us see. Tell me. A by D equal to A by B, ask of, everyone, A by B, rupee by dollar into ask of A by B into B by C, B by C into ask of C by B by C into C by D, C by D. Now you see the question and tell me, ask of rupee by dollar, can we calculate? Ask of rupee by dollar. Here rupee yen quoted, dollar pound quoted, yen dollar quoted. We want rupee by dollar. Rupee by dollar is quoted, not given in the question. Problem will come. Did you understand the concept? Dollar pound quoted each other. Okay, pound and yen, pound and yen. Pound and yen is also not quoted if you look into. So pound yen will come. Pound yen also not quoted here. Here what are quoted? Here rupee pound quoted, dollar pound quoted, U and dollar and yen are quoted. What is not quoted? Pound is not quoted to yen and rupee is not quoted to dollar. Therefore again for these two you need to calculate cross currency, which becomes a lengthier process. Therefore whenever a per unit currency is repeated multiple times, take that as a B. Remaining currency take it as C. This is how the calculation has to be made when 3 currencies are given. This may be kept in the basic problem, but this is an advanced model of how a question can be asked in examination with regard to cross currency quotation with how many currencies inside? 4 currencies inside it. Okay, so try to understand 2 important points here. If 3 currencies are given, follow A by C model. 4 currencies given, follow A by D model. A by C will be taking out A by B into B by C. 4 currencies will take out A by B into B by C into C by D, which will eventually calculate A by D calculation. When you take 4 currencies, A will be unknown, D will be known, but what should be taken in B itself? If 3 currencies are there, no problem, only one common currency will be there. But when 4 currencies are given, which should be taken as B? B should be that currency which get repeated on the per unit side for multiple times. Take that currency and calculate. This is how we need to understand. Clear everyone in the class? So everyone should understand this logic very, very clearly. But why it has to be done, we will have one problem at that time. I will explain why B should be always multiple currency repeated on per unit. Reasoning also I will tell in that problem, okay, when we come there. But as of now, hope everyone understood the logic clearly, right? Please copy down the answer. Question number 13. Question number 13. So hope everyone has completed writing. Next. So now we completed question number 10, 11, 12 and 13. With that we have completed the concepts regarding the cross currency quotations. Next, one very important concept is going to come, 14, 15, 16. This is another set of discussion. Okay, now question: what is spot rate, what is forward rate, what is a swap rate and how it is expressed, how swap rates are adjusted to spot rate when given in ascending and descending terms, and what is a spread. Questions again: what is a spot rate, what is a forward rate, what is a swap rate and how it is expressed, how swap rates are adjusted to spot rate when given in ascending and descending terms, what is a spread. Let us understand every point clearly in detail. Okay, what is a spot rate? Let us understand. Spot rate is a rate that is quoted today by the banker for a transaction to happen today. Repetition once again. Spot rate is a rate that is quoted today for a transaction to happen today. That means you go to the bank, he will give a rate and you are going to convert your dollars into rupee, or you want to buy the dollars in exchange of rupees at spot. That means immediately the time on which you are asking the quotation is the time on which you are executing the contract. That rate is called as a spot rate. That rate is called as what rate? It's a spot rate. I repeat for the last time. Spot rate is a rate that is quoted today for a transaction to happen today. That rate is called as a spot rate. That rate is called as what rate? It's a spot rate. Next, what is a forward rate? Forward rate is a rate that is quoted today for a transaction to happen at a future date. I repeat, forward rate is a rate that is given today for a transaction to happen at a future date. Means what? You will go to the bank, you will tell, I have export receipt after 3 months. After 3 months you will receive the dollars, but by the time you receive the dollars, rate may fluctuate. Therefore you will enter into a forward rate today itself. Means you will lock a price, you will lock yourself to a price today itself. On that day the price may be decreasing, but you will get the same price for your dollars sold. So therefore try to understand very clearly in detail. Whenever there is a forward contract, forward contracts are entered for hedging. What it's a hedging? Hedging means what? Risk coverage. You will import goods today, you have to pay in a future date. On that day when you go for the payment, dollar rate may be exorbitant and increase. Therefore we will lock at a rate today itself. Even if the rate is prevailing at a higher at that time, you will be executing the contract only at the executed price with the banker. So therefore that's the benefit of entering into forward contract. For forward contract, a rate should be finalized or not. That rate we call as a forward rate. Forward rate is a rate that is quoted today for a transaction to happen at a future date. For a transaction to happen at what rate? It's a future date. Okay, that's called as a forward rate. So now summarize. What is a spot rate? Spot rate is a rate that is quoted today for a transaction to happen today. Forward rate is a rate that is given today for a transaction to happen at a future date. That means in future that price may be there, may not be there, but we will lock ourselves to that. Even if the price changes on that day, that will not impact me. Okay, that's called as a forward rate. Now the question arises, sir, how this forward rate is calculated? How this forward rate is calculated? Forward rate will be calculated in so many ways. There is a way called as PPPT, purchasing power parity theory. There is another model called as IRPT, interest rate parity theory. In that model also you can calculate forward rate. Okay, this is there. We will calculate the fair forward prices. What prices are? Fair forward prices. What is fair forward prices? The price at which dollar should have been traded. I repeat my language. The rate at which dollar should have been traded will be calculated using PPPT and IRPT. But actually what will be quoted by the banker may be different. Therefore, forwards can be of two types: actual forward and fair forwards. Fair forward we can calculate using PPPT and IRPT. Okay, but actual forwards are given by the bankers. No theory will be there for them. Those are called as actual forwards. Now how the banks will calculate? They will take a spot rate. They will take a spot rate and they will be giving us a swap points. They will be giving us what points? Are swap points. These swap points will be either added to spot, maybe either deducted from spot. When to add? If these rates are given in ascending order, we need to add. If these swap points are given in descending order, we need to deduct. Sir, why sir we need to mug up like that? Ascending order add, descending order deduct. Fool will do like that. Okay, but we are not fools and we are not machines just to give a command and execute it. We need to understand why. So many times in the classes I used to tell the same very important point. Bahubali didn't become popular because of the reason that Kattappa killed Bahubali. Okay, the fact that Kattappa killed Bahubali is known to entire India. But what created curiosity? Why Kattappa killed Bahubali? That became a hashtag WKKB. Why Kattappa killed Bahubali created curiosity, not whether Kattappa killed Bahubali. Well, everyone know, because it was clearly identified and it was clearly given over to the audience that one person has killed that another person. Everyone know that. But what created curiosity? That why created curiosity, which always I want to deal with. In SFM in law, what we treat is not what is that provision, why that provision came. In SFM, not what is the concept of ascending descending swap. We need to understand why we need to add, why we need to deduct. That we are going to learn in the next stage. Repetition for the last time. Spot rate is a rate given today for a transaction to be executed today. Forward rate is a rate quoted today for a transaction to happen at a future date. Swap points. What is the swap? Forwards can be of two types. One is a fair forward, another one is an actual forward. Fair forwards are calculated through theories. Actual forwards are given by the bankers. How that actual prices of forwards will be given? Those actuals will be given by the bankers by adding and deducting the swap points. By adding and deducting what points? Swap points. Swap points may be given in ascending order. Swap points can also be given in descending order. If ascending swaps are given, add. Descending swaps are given, deduct. Why? We will discuss next. Swap rate. Okay, how the swap rates are adjusted? Ascending will be added, descending will be deducted. Spread already we understood na. Let's cancel this. Spread means what? Difference between the bid and ask is called as a spread. Okay, spread. Now when it comes to swap points, there are three types. This I want to explain clearly. There are three types. Number one, first type is called as points. Second type is called as ticks. Third type is called as pips. Okay. First one, you need to understand the technical language. Okay. First one is called as a points. Second one is called as a ticks. Third one is called as a pips. First foremost concept everyone has to understand. Foreign currencies are always denominated in fourth decimal. So, what do you mean by points? What do you mean by ticks? What do you mean by pips? Let us understand clearly. Pips represents points in percentages. Points in percentages. Sir, really is there any impact of understanding these in the examinations? Or else, do you think I am a fool? So it is obviously relevant, else why I will discuss unnecessarily. Okay, what is this point? Shall I show you where that question came? First I will show you that, or student will not believe first. This is the first overaction. See this swap point 0.0001. What to understand this? Do you want to understand this as a ticksa, pipsa or a pointsa? That we need to have a clarity. Not only this question. Okay, I will show you latest examination question also. Fourth decimal in multiples of 0.0025. How to understand this? Is this a pip or a tick or a point? How to understand this? These clarities without having, if you do the problem, na sir, we will become the biggest two fools on this planet. That problem you will do. New problem comes na, hands up again. That's the problem with SFM. Question paper will be easy until and unless they came from the past exam questions. Question paper la twist happened na, that's all. Gone. That should not happen. When that will happen? If there is mugging up of concepts rather than understanding the logic behind, that problem will come. Okay. Again, See here, 3 months premium 0.87 and 0.93% they have given. This is called as a points in percentages. This is also examination question. If you want, you go to the study material. If really this question is not there in your study material, then put a direct message in the YouTube lecture itself. Sir, what you said is wrong, sir. In the institute material, the type of question is not there. Pips is there, ticks is there, points also there. What it is, let's try to understand. Okay, so names they may not use, but technically I want to use the names. I don't want my student to just understand the concept. Let us understand the technicalities of the particular market. When you are coming into the stock market, the words like short, long, how important they are. When you are coming into the foreign exchange market, understanding the points, ticks and pips are also equally important. Let us understand now. See here, $1 equal to rupees, say for example 70.1532, some random number I am writing. So 70.1532. Sometimes they will give, there is 1 point change, 1 point change, not swap point. Directly they will use the language 1 point change. Then you need to add this 1 point to this is 70. That means 70 has become 71.1532. This is called as a points. Points will be adjusted to the left side portion of the decimal. Ticks. $1 equal to rupees 70.1532. Now what they will do? They will tell there is a change of 1 tick. They will tell there is a change of 1 tick. Tick is always 0.0001. It can be 0.001. It can be 0.01. It can be 0.1. They will clearly tell what is 1 tick point equivalent. That's what you have seen now. 0.0025 they have taken 1 tick. Tick is always adjusted to the right side part of a decimal. Ticks are always denominated in ticks are always denominated in lot size type. 1 tick equal to 0.0001, like that they will tell. Most of the problems ticks will come. Okay, so 0.001 means, for example, if I tell there is a 2 ticks changes, what do you mean 2 ticks changes in this case? 0.0025 into 2 means how much? So take 0.0025 into 2 means how much? 0.0050. So you need to add 0.0050. This is how you need to add. Okay, 2 ticks. 1 tick is 0.025. 2 ticks means 0.0050. Okay, this is how you need to do it. This is called as a ticks. Ticks way, sometimes it depends on what denomination he have given in the question. If he given in the denomination of 0.0001, you have to adjust accordingly. If this is given, adjust accordingly. This is given, adjust accordingly. They will tell tick increase, tick decrease. Okay, this is how the ticks will be calculated. Pips, instead of telling it in instead of telling it in currency, they will give in percentages. They will give in percentages. You should adjust to the right side part of decimal. Mean this part of decimal you need to adjust. Percentages they will give. How the percentage will be? Say for example 0.8% he will tell addition. Okay, take calculator. 70.1532 into 0.8%. 0.8%, 0.5612. So that you need to add 70.1532 plus 0.5612. This is how you need to add. This is called as a points in percentages. Points in percentages. It's called as a pips. So in examination, all the three are tested. But we don't know the technical names because institute study material they didn't give. Points is a way in which we will adjust to the left side part of the decimal. Generally problems are not asked on that. One problem came till now. Ticks will always change the right side part of a decimal in numericals. Pips in percentages they will give. Pips is nothing but ticks given in a percentage format. Okay, these are all the swap points adjustment. Sometimes in the question directly forward rate will be given. Those are called as outright forwards. Those are called as outright forward. Outrightly they will give the forward rate. Those are called as outright forward. These are called as adjusted forwards. These are called as adjusted forwards. Adjusted forwards means what? Spot rates will be given. We will adjust the swap points to them. Okay, points, ticks and pips. This is the concept that we need to understand. This is a general concept. Sometimes he will intentionally tell adjust to the last two decimals clearly. At that time you should not use your own ideology, adjust according to the institute question given. Sir, I can't understand what you said. No problem, sir. One problem is there. At that time I will clearly explain what I mean to say in this case. Okay, 99% of the problems will be running on the same logic. Okay, what I said now, points, ticks and pips. Let us see the point now, how it has to be understood. So now we completed spot rate, forward rate, what is a swap rate and how it is expressed. Swap rates are to be adjusted to the spot rate. If it is given in ascending order, how to adjust, descending order, how to adjust, everything we understood. And what is the concept of spread? Spread is the difference between bid and the ask. Spread is the difference between what's the bid and the ask. Now last question. Sir, whenever a quotation is given and the swap points are given in a ascending order, we will add, sir. Descending order, we will deduct. What is the reason? What is the reason? Mugging up is not the reason. There should be some other reason behind that. Okay, see here. $1 equal to rupees 70 point some number I will write, or 75.1283 some number. Okay, dash rupees 75.1532 some number you take randomly. I have given swap points ticks in this way, 0.0123 dash 0.0134. This is given in ascending, descending, increasing trend, decreasing, increasing. We have to add. So add 0.0123, 0.0123. Next 0.0134. Add it. Take calculators, everyone. $1 equal to rupees 75.1283 plus 0.0123. 75.1406 dash 75.1532 plus 0.0134. 75.1666. 75.1666. Okay, now see here. Now my question is, why we have to do like this? Why can't we deduct when it is given in ascending order? There is a FIDI rule, Foreign Exchange Dealers Association of India. They have entered into a common policy that future should be always more optimistic than present. Future should be more optimistic than present. Okay, what is this optimism? Optimism means always future should be more lucrative than the present. Okay, what does it mean? I will explain. See here now. They have entered into agreement saying that forward spread should not be less than spot spread, or maximum times forward spread should be more than spot spread. What is the forward spread? Difference between ask and bid in forward. So calculate 75.1666 minus 75.1406. How much is the spread here? 0.026. Now calculate the spot spread. 75.1532 minus 75.1283, 0.0249. Okay, now you can observe spot spread is lesser than forward spread, or forward spread is more than spot spread. Okay, so there is a change, there is 11 points change is there. So forward spread is higher than spot spread. At least 0.0001 difference also at least must be there. Okay, this is the point. So forward spread is greater than spot spread. In this case, instead of given, if it is given in ascending order, instead of adding, if you deduct, what will happen? Let us see. Take calculators. 75.1583, sorry, 1283. 75.1283 minus 0.0123. How much it is? 75.116 dash 75.1532 minus 0.0134, 75.1398. Here ask is greater than bid. I'm not doubting that. So calculate the spread. 75.1398 minus 75.1160 equal to 0.0238, where the spot spread is 0.0249. That means the gain what the dealers are going to get in the future is lesser than the gain that we are getting today. Means why they will make the trade? When they are already knowing about the fact that forward is giving me a loss, why a dealer will make a trade? Obvious answer, na? Dealers should always trade in foreign exchange if the forward is lucrative for them. If forward is beneficial and giving a more profit than today, then they will enter into the transaction of profit and gain. If they already know that the profit in the future is lesser than profit in the present, then why I have to trade? When I am knowing that I am going to get a lesser profit than today, why I will trade? So therefore, always the future should be more lucrative and optimistic for them. In order to have that, a rule called as the Rule 14A in the FEDI has been inserted. Law నేర్చుకుంటే benefit ఏంటి, ఇది benefit. So if you know law, you can interpret both. That's why law and SFM is a rare, deadly combo. So when the FEDI rules, if you observe, in that FEDI rule, rule number 14 capital A has given a clear thing saying that dealers always agree to have a forward spread to be more than the spot spreads. So if the forward spread should be more than spot spread, they should be adding if it is given in ascending, they should be deducting if it is in descending. Because of that reason, ascending swaps are added, descending swaps will be deducted. Hope you are clear to the point, everyone in the class, right? Yes. So now you have a license to copy down. First, I will read it. Spot rate is a rate quoted today for a transaction to happen today. $1 T0, today's rate 70-75. Forward rate meaning forward rate is a rate quoted today for a transaction to happen at a future date. $1 3 months after, 6 months after, 9 months after, 72-77. Swap rate and its expression. Swap rates are points adjusted to the swap rate, spot rate, to arrive at a forward rate. To understand this, one need to first understand the following. Generally, quotation shall be made in 4 decimal fractions. There are 3 popular types of adjustments: points, takes, and pips. Points represents the smallest possible price change on the left side of the decimal point. Ticks represents the smallest possible change to the right side of the decimal point. Pips represents the smallest percentage change in the price on the to the right side of a decimal. $1 equal to rupees 70.7439. If the 70 is changing by 1 or decreased by 1, increase will make it 71, decrease will make it 69. This is called as a points change. When I use the word swap points, they will give 0.00 like that. Okay, 0 point or 14-15 they will give. Those are all ticks adjustment only. Those are all ticks. He will clearly tell exchange point change. Then you need to change to the direct amount. So $1 equal to 70.7439. Tick size can be 0.1, 0.001, 0.0001, like that he can give. So this is how adjustment. If the tick size is given in 0.25 etc., 1 tick change represents 0.25, 2 ticks change represents 0.5 value, like that. Okay, $1 equal to 7439. The value that is obtained is adjusted to the last decimal and the movement leftwards. Means what? 0.8% he said. So from the left side you need to change. Sorry, from the right side towards the left side you need to come. From the last decimal you need to make a change. Pips means point in percentages. It is nothing but ticks in percentage format. Okay. Next. Swap points adjustment. Nature of swap points. Swaps in ascending add, swaps in descending deduct. The reason behind this is, as per FEDI rules, forward spread should be always higher than or equal to the spot spread, but should not be lower. This can be explained using an illustration as follows. $1 equal to rupees 70.2388-73.2398. Swap points 14 and 25. Here swap points are in ascending order, so we need to add. If we deduct, FEDI rules get violated. I have done 2 things, actual and violative. Actual, $1 equal to 70.2388-70.2398. Swap points 0.014, 0.025. I added spot spread 10 points, forward spread 21 points. Profit is more there. it will be more optimistic. Violative if you do. Spot spread is 10, forward spread is 1 point. Why I will do when they know that I will only get 1 point for profit in the future? I will not enter into forward. If you don't enter into forward contracts, exports and imports get damaged. Exports, imports get damaged, GDPA damage. So they are very, very serious about this. Same concept apply also in case of points in descending order. Am I clear? So let's write down the notes clearly. Write down the notes. So let's continue writing. I mean, let's solve the problems now. See here. There are two questions that are given in this area. One is spot rate is given as 1 euro equal to dollar 0.6963 dash. When I give like this, adjust to the last decimals always. It's a ticks points. 0.06963 dash 0.6968. Swap point 1 month is 4 dash 6. Nothing is given. How to do 1 month swap rate? He gave and stopped. Understand, in the problems you should assume those as a ticks. Adjust to the last decimal. Okay, so if they clearly give it's a swap, if it is exchange swap points, then you need to adjust here. Okay, so by common sense also 0.06963 will not suddenly become 4.6963. 400 times increase means that country will die the very next day. Okay, compute the forward rate. How to do? 0.6963 dash 0.6968 plus it is in ascending order 0.0004 0.0006. Okay, that's all. Let us do next problem. Also I will first tell you how to do, after that you can directly copy. 2 point, how to do this? 2.0015 dash 2.0030. okay, 19 and 17 is given in descending order, minus 0.0019 dash 0.0017. okay, in this case also there will be that spread advantage that will come. okay, if you do, what is the swap spread, what is the spot spread? 0.0015. okay, let us see this. 2.0015 minus 0.0019, 1.9996 dash 2.0030 minus 0.0017, 2.0013. Here 0.0015 is the spread. okay, here let us see 0.0013 minus, okay, 0. Or 2.0013 minus 1.996, 0.0017. again forward spread is higher than spot spread. If you do addition here in this case, what will happen? Let us see. If you do addition in this case, 2.0015 plus 0.0019, you add it, it becomes 2.0034 dash 2.003 plus 0.0017, it becomes 2.0047. so 2.0047 minus 2.0034 will be 0.0013. forward spread is lesser than spot spread. That means the bankers will know that the gain we are going to make at a later stage is a loss when compared to the today's stage. I mean, why they will trade? Why they will trade? Unnecessarily they will try to manipulate the prices. Therefore, in order to avoid all those things, concept A, law has said, FDI rules has said that if ascending swaps are given, add, descending swaps are deduct. For what reason? In order to maintain a concept of forward spread should be greater than spot spread. Okay, copy down both the answers. You can take it as 1 month pips or 1 month ticks. Pips is a percentage. Percentage anyway, if you apply to the if you apply, you will get amount only na. So like that you can understand, or ticks, anything is okay, no problem. Copy down the answer, everyone. Complete it. Completed writing? So now we completed problem number 15 as well as 16. So with this we have completed problem number 15 and problem number 16. Okay. Now we are left out with only one concept in the basics. 17th question. What is that? What is appreciation and depreciation of foreign currency? What does it mean? How it is represented through a formula and derive the formula. Okay. So now this is one very important concept which will help us to understand, and this concept will be useful when we are doing a concept called as covered interest arbitrage. What it is? Covered interest arbitrage. When we come into that concept, the concept of premium discount will help you, and this concept will help us in another model called as a leading and lagging. Leading and lagging, when we are doing those two, when we are doing leading lagging problem, or when we are doing the covered interest arbitrage, this concept will help a lot to understand various concepts inside that. So before we go into that, everyone in the class, make yourself thorough with the concepts of appreciation, depreciation. Logical interpretation we are going to make. This is a fairly a lengthy discussion. Once you understand this concept, answer writing and doing the problems will be just like that, we will complete off. But the problem is we need to understand what is this appreciation, depreciation. Generally how the students are understanding. First I will tell you, okay, how they will read. Appreciation depreciation equal to F minus S into F minus S divided by S into 12 by N into 100. What is this? It will come in a percentage that we will adjust. I'm not asking about all those things, whether you will apply percentage, whether it is 1% or 2%. I'm not asking all those. I am asking what is this whole idea of appreciation depreciation, how it will be useful in Forex, how it is useful for solving the problems, that we are going to understand in the next part of the discussion. This is a fairly lengthy discussion only. Understanding of this concept will take 15 minutes. Notes writing and all the other things and doing a problem will take another 15 minutes. So it will be a half an hour discussion on this concept called as a appreciation and depreciation in foreign currency. Okay, before we go into that, let me first explain you the idea behind this particular concept. So now let us now start with the last basic concept called as concept of appreciation and depreciation of foreign currency. Everyone please keep the heading appreciation and depreciation of foreign currency. Keep the heading, everyone. Okay, appreciation and depreciation of foreign currency. Okay. So first what I will do is I will put my discussion in a more logical format first. Once it is completed, then we will be going into the discussion from the Forex point of view, such that you can really understand the knack over this particular area called as appreciation and depreciation. So all these notes we need to write. Once this notes is completed, we have one small problem in which we need to compute. Once that is completed, appreciation, depreciation in foreign currency also you will be thorough in understanding. Okay, so let us start with our discussion. See here, what is this concept of appreciation and depreciation? See here, I will give you quite a good examples to understand this. See here, Mr. A purchased TCS share at rupees 100 today, and he hold this particular share till 1 year when the price is running at 120. Now if you ask Mr. A how much return you made out of the holding of TCS share, means what he will tell, my return or return on investment equal to return divided by investment into 100. Return means what? I purchased, I sold at 120, I purchased at 100, whole divided by 100 into 100 means how much percent? 20%. This 20% we call as a return per annum. My holding period return, my yearly return, because I held for 1 year. Okay, so I purchased a TCS share at 100, and the price at the end of the year is 120. I didn't sell. I didn't really sell. Price at the end of the year is 120. If I would have really sold it, I would have got a return of 20% or not. This is called as inherent return. Inherent return. Inherent return means what? Return can be of two types: realized return, unrealized return. Realized return means what? Really you got it. It's called as a dividend in case of a share. It's called as what's a dividend in case of a share. Okay, there will be other things which we will call as a growth, growth is an appreciation or depreciation, appreciation. Okay, now this TCS share has appreciated by 20%. Appreciated by how much, sir? 20%. Okay, now listen carefully to the logic. The sense of concept is important here. TCS share is trading at 100. I purchased at 100 and the share price at the end of the year is 120. I didn't sell it. If I would have sold it, I would have sold it for 120 or not. That means I am making a flat gain of 20 bucks. Simply to understand, I am making a flat profit of 20 rupees per each share or not. So if I would have sold, I really didn't sell. If I would have sold, I would have got a 20 rupee return or not. That means this is called as a implied return or inherent return that the CCS share is giving. That itself is a return formula: D1 plus P1 minus P0 whole divided by P0 into 100. That P1 by P0, D1 plus P1 by P0 whole divided by P1 minus P0 whole divided by P0. Yes or no? D1 by P0 plus P1 minus P0 whole divided by P0. This D1 by P0 is real return. This is called as unrealized return. This is called as a realized return. This is called as unrealized return. This unrealized return itself we call as, this is dividend. This is implied dividend. Means what? Really it is not given as a dividend, but implied, like the dividend, this is also expressed in a percentage. Okay, so this is what we want to first convey on a share. Sir, why suddenly share market is coming in Forex? Let me explain you the concept clearly now. Now see here, I went to a bank. I went to what, sir? Bank. I went to the banker and I asked him, sir, what is the dollar rate today? At what rate the dollar is getting traded? I asked him. Banker immediately saw him and said, dollar today is 70 rupees, he said. I said, sir, I want $1. Really $1 will not be sold. Example sake, let us take $100 now, $1 I will take. I asked, I want $1. Banker said, give me 70 rupees, I will give you $1. I gave 70 rupees. He gave me $1. He gave me what, sir? $1. $1 I took with me. I went home. I kept in a almirah. Okay, I kept in the almirah. $1 invested at 70 rupees. 1 year completed. I went after 1 year. 1 year over. From the almirah I have taken that $1. I went to the same bank. I asked him, sir, what is $1? 2023 December he said this. 2023, not 22, 23, 1 year after. Okay, I asked him, sir, what is the dollar rate? I asked the banker. He said, sir, 85. Immediately I said, sir, I have $1, will you buy? He said, okay, we will buy at 85. I gave was $1. Immediately he gave me 85 rupees. Means I purchased at 70, I sold at 85. I sold at 85. Means like a share, I am investing in the dollar, I am selling the dollar. Technically dollar don't give any dividend. The only return that a dollar gives is its appreciation in value. Okay, that means if you invest in the dollars, then how much you have purchased? You purchased at 70, you want to sell at 85, you are having a flat gain of 15 rupees per each dollar or not. So 15 divided by 70 into 100, 15 divided by 70 into 100 is 21.43%. 21.43%. This percentage is increased or decreased? Increased. This increased percentage we call as appreciation in dollar. Appreciation in dollar. That means simply I can make it like this. I purchased a dollar at 70. The rate is now 85 after 1 year. I didn't sell. If I would have sold it, I would have got a return of 15 rupees or not. return, not total realization. Total realization will be 85, but return means the difference between cost and sale. So if I sold, I would have got 15 rupees gain or not. That 15 rupees gain I would have got if I sell. I didn't sell. Now that 15 rupees is a implied gain for me. If I really sell, I will get it. This is called as implied interest rate. Implied interest rate. Dollars don't pay interest, but like interest on a debenture or a dividend on a share, it is giving me a return of 21.43. That means a dollar, when it is understood as a mode of investment, like a share, I can buy a dollar. Dollar gives me, share gives me a return. Here also it is giving a return. Dollar is giving me a return of 21.43 percentage. This concept is called as a return on investment on dollar, also called as a implied interest rates on dollar. That's why it will be used in covered interest arbitrage concept, because it is an implied interest rate. At that time, for those interest rates, these appreciations and depreciations are adjusted. When we come to the covered interest arbitrage concept, very clearly, in depth, with live examples I will discuss. Okay, such that you will not get any kind of doubt in the examination when you are doing or solving any kind of problem. So I repeat once again, like a share, dollar is also a piece of investment. Dollar is also a piece of what, sir? Investment. So like a share giving a return, dollar is also giving a return here. Therefore this is called as a implied interest rate, also called as a implied rate of return, also called as a premium or discount on the forward. Premium or discount on the forward. So this return of 21.43 is coming to me because of what? Because of waiting till the forward rate. So this is called as a forward rate. In this forward, there is a return. Okay, therefore this is called as a forward premium or a discount. Rather than calling it as an appreciation or depreciation, I can call it as a forward premium or discount. Forward premium or discount. Okay, now simply, this is a insult to the rupee. It is a betterment to the dollar. Means $1 is available at 70 before 1 year, but the same dollar is available at 85 today. It's an insult to the rupee because rupee purchasing power has been reduced. This angle we are going to analyze in purchasing power parity. But on the benefit side, dollar is generating a return of 21.43. This we will analyze in the interest rate parity. So like this, we are going to analyze the Forex chapter in a correct way, rather than mugging up the concepts or by hearting the formula or just doing the problem and answer. We are going to analyze this purchasing power parity theory and interest rate parity theory. In case of purchasing power parity, we are going to see the decreasing purchasing power of a rupee, and in case of interest rate parity theory, we are going to see the implied interest rate a dollar is giving us. Not just dollar. Here in this case, I have taken example as a universal currency being dollar. We will be taking pound, we will be taking euros and doing the problems. Okay, so therefore try to understand. Don't call it as appreciation and depreciation and make it far away from understanding. Call it as a implied interest, call it as a implied return, call it as a inherent interest rate, call it as a premium or discount on forwards. Okay, now how this 21.43 came to us? 21.43 came because we have written 15 by 70 into 100. Okay, if it is held for 1 year, this is the answer. I hold only for 3 months, then what is the answer? I hold for 3 months. Today it is 73 months after 85. Generally it will not rise like that. Example. Okay, it rise like that. Then how you should calculate? 21.43 into 3 by 12. 21.43 into 3 divided by 12. 5.3575%. 5.3575%. This is called as holding period return. This is called as what return? Holding period return. Okay, so now how the 5.3575 came? 15 by 70 into 100 into 3 by 12. How this 15 by 70 came? 85 minus 70 divided by 70 into 100 into 3 by 12. This 85 minus 70 is called as a return. This 70 is an initial investment. This is a return on investment. Return on investment. So appreciation and depreciation can also be understood as return on investment. Okay. 85 is the forward rate, 70 is the spot rate, 70 is the spot rate, 3 is the n period, 12 by n. So formula is f by s by s, f minus s by s into 100 into n by 12. This is how the formula has been derived. Okay, so don't read it as appreciation depreciation. You can use it, but maximum possible extent understand this as a return on investment. Understand it as a return on investment. Okay, now in some cases people use first let us try to understand. $1 equal to rupees 70 dash rupees 75, 70 dash rupees 75. This is a spot rate. $1 equal to rupees 75 dash rupees 80. Now there is a bid premium, there is a ask premium. If the price of dollar became 68 dash rupees 72, there is a forward discount premium, forward discount, and ask discount is there, bid discount is also there. So appreciation can be there, depreciation can be there. How appreciation will help us, how depreciation will help us, we will understand. Sir, if it is depreciated to 68 and 72, purchasing power parity concept point of view, rupee has gained its power, because a dollar is available at 70, is now available only at 68. Now there is a positivity in that. However, implied interest will be reducing, therefore interest rate parity angle, it is a diversified, and it is contrast, it is more negated in that view. So therefore these all price angles, interest angles, percentage angles, we are going to understand in the further sessions. Okay, we are going to analyze very clearly, in depth we are going to analyzing every point. Okay, so forward need not be always having a premium. Forward can also have a discount. Forward can also have what's a discount. At that time this is called as a discount, or also called as a depreciation. Also called as what's a depreciation. At that time implied interest rate will be a negative rate. How that impacts, we are going to see that in an area called as a covered interest arbitrage. A fantastic area, mind blowing area. That concept in my screenplay, how it will be, you can imagine. That covered interest arbitrage concept, if that movie is screenplayed and directed by me, direction of covered interest arbitrage, Koushik Mukhesh, you can imagine how it will be. So covered interest arbitrage, all the angles, purchasing power parity impacting it, or if it is a forward premium discount, or into implied interest rates, okay, how dollar and rupee will be colliding each other, and how the interest rates are getting impacting the foreign exchanges, every single thing we are going to analyze in an area called as a covered interest arbitrages. Okay, before going into the next conclusion, f minus s by s into 100 into n by 12 is a formula for what? Is a formula for forward premium or discount on a per unit currency, also called as a foreign currency. Home currency formula, s minus f by s into 100 into n by 12. But this has no meaning. Answer will come. Theoretically one answer will come, but there is no meaning for that. Shall I tell you why? See here. S minus f by s into 100 into n by 12. You will get a percentage. But that percentage has no meaning actually. Shall I tell you why? I will explain. See here. What is f minus s? $1 today is 70. $1 is 80 after 1 year. Now, dollar is now trading at 70. The same dollar after 1 year is trading at 80. Okay, the dollar is now trading at 70. The same dollar after 1 year will be traded at rupees 80. Dollar will have a inherent increase. Now tell me, $1 is 70 today. $1 is 80 because dollar is invested somewhere. Dollar is invested somewhere. What I said, that's why I purchased a dollar from a bank, kept in my almirah. After 1 year I went to the bank. After 1 year I went to what's our bank. At that time they have quoted a price of 80. I sold to them. That means in reality I sold, I didn't sell, but there is a rate of 80. That means 870 became 80 because dollar is deposited in bank. No, I kept in almirah. That's why I clearly use the word almirah there. In the drawer I kept it, in the almirah I kept it, in my pocket I kept it. After 1 year again I have taken it. That means without doing any additional investment, without doing any additional effort, dollar inherently generated a return of 10 rupees. Am I clear or not? Now common sense. I have 100 rupees with me. I have 100 rupees with me. 100 rupee note is there. I kept in my pocket. Okay. From that pocket I have taken 100 and kept in the almirah. Dollar note is there. 100 rupee note is there. Both kept in the almirah. After 1 year, I took this dollar, went to the bank. They gave me 80. There is a gain of 10 rupees, even though I didn't do anything with the dollar. Ideal dollar has generated a return. I took this 100 rupee to the bank. I gave to the banker. He have given 10 rupee notes. Shock. Okay. He said, you didn't deposit it. Why I will give you 101 rupee or 110 rupee? That means rupee don't generate any implied interest in India. Rupee will generate a return only if it is invested. There is no implied interest on rupee. There is actual interest on rupee. Dollar has generated a implied interest in my example. Okay, what do you mean by implied interest? Though I didn't make any kind of investment, dollar has generated a return. Like that rupee don't generate because rupee is a home currency. Yeah. Home currencies don't have any inherent return. Home currencies will have actual return. You have to invest it. Then where is the concept of S minus F? Spot minus a forward. They will take home currency. They will convert. Common sense let us use. Use common sense. Rupee, formula sake don't put numbers. There should be logic in doing anything. Na? So therefore, home currencies don't have implied interest. So therefore, for example, $1 equal to rupees 70. $1 equal to rupees 80. Okay. Now in this 1 rupee equal to 1 divided by 70. 0.0143. Next 1 rupee equal to 1 divided by 80. 0.0125. 0.0125. Now answer my question clearly. What is the rupee here? 0.0125. What is here? 0.0143. Dollar appreciated means rupee depreciated. Is that a great logic? Automatically it will be negative. So 0.0125 minus 0.0143 divided by 0.0. Okay, S minus F by S. S minus F by S. Or sometimes they will also take F in that particular forward and they will calculate. So you take 0.0143 into 100, you will calculate. You will get a number. Okay. Now what you have to understand in this case, this formula you can't apply because India la why rupee will generate inherent return here? Why it will generate inherent return? This must be used by a US person. This must be used by a US person. In India, we don't calculate rupee forward and premium. Rupee don't have inherent forwards and discounts. Rupee will be getting a return only if it is invested. Dollar will get a return though it is not invested. Dollar I kept in my pocket. After 1 year I have taken 70 became 80. This is called as an inherent return. Like that if you take a 100 rupee note, 100 will remain 100 even after 1 year because it has to be invested somewhere to get the return. Dollar generates inherent return, rupee generates actual return. Therefore, there is no concept called as premium discount on home currencies. Premium and discount will be always calculated only on foreign currencies because foreign currencies only will have inherent interest rates. Clear everyone? Therefore, F minus S by S into 100 into N by 12 is the correct one. Clear everyone in the class? So this is the idea behind this particular concept. Hope everyone understood the logic behind this premium and discount concept. Am I clear? So let us see this. Okay. The concept of appreciation and depreciation analyzes implied return on foreign currency. This concept is also called as forward premium or discount. This explains the inherent return earning capacity of any foreign currency. This can be understood with the following illustration. Whatever I said I have given in theory. Mr. A has bought a share at rupees 100 today and held it for a period of 1 year. And held it for a period of 1 year. Okay, where The price went to rupees 120. Now what is the profit? What is his profit in rupee terms and profit in percentage terms? This is the question. P1 minus P0 by P0 into 100, 120 share, 100, it is the investment rate. So percentage 20, written in rupee terms 20 rupees. One can observe that share has inherently generated a return of 20%. If Mr. A would have really sold his share, he would have got a return of rupees 20. That means it is implied return, also called as an unrealized capital gain. Like a share, foreign currency, say dollar, is also a commodity. Suppose Mr. A bought a dollar when it is trading at rupees 70 and held it for 1 year when dollar is trading at rupees 85. Here in this case, the dollar, if it is sold, then Mr. A would have made a straight profit of rupees 15, where his return on investment on dollar will be 21.43% per annum. That means without any additional effort, just by holding a dollar for 1 year, there is an appreciation of 21.43%. It is something like interest paid by dollar, though it is not in reality. Therefore, this concept is called as a premium or discount or implied interest rate or inherent return on foreign currency. However, always the holding period need not be 1 year. In such a case, the return as calculated above shall be adjusted for holding period. In the above example, if the holding period is 3 months, implied interest on dollar is 21.43% into 3 by 12, 5.3575%. The derivation will be like this: 85 minus 70 by 70 into 100 into 3 by 12. 85 by 70 will be return, divided by 70 will become investment and return on investment, into 100 into holding period 3 by 12. That will give you holding period return. 85 is the forward, 70 is the spot, and 3 is the N. F minus S by S into 100 into N by 12. It is to be noted that though it is theoretically possible, there is no sense of calculating premium or discount on home currency or number of units currency. This is the whole concept behind the area called as appreciation and depreciation in foreign currency. This concept is otherwise called as premium or discount in the foreign currency. Premium or discount in what, sir? Foreign currency. Generally, in case of a home currency, we should not calculate premium discount, because premium discount in this area is a inherent premium discount. Rupee don't inherently generate any kind of return in India. Rupee will generate a return only if it is invested. Okay, dollar is not invested elsewhere. I purchased dollar at 70. I kept the dollar in the Almara. After 1 year, I went to the bank. Bank has given me 85. Without any additional effort, I am getting that 15. That's called as a implied interest included into the dollar. So everyone in the class listening, put the comments in that particular comments box how you felt about this concept. So just this is a motivation for me. Okay, that does not mean that if you don't put a comment, I will stop this. But every effort will be paid back. We will also get a motivation that yes, everyone is understanding to the concept. So just for that good one reason, I am asking you, put a comment. I can really feel motivated that everyone has understood, or I taught something which they don't know, and others also will know that what Koushik Mukhesh actually is. So for all these reasons, if you really find it, the lecture is really found to be useful for you, please put and drop a comment below such that I can really understand, because this lecture I am keeping in YouTube. Okay, normally Google Drive also I will upload along with that. This lecture I am also uploading in the YouTube now, because people are always making a message that, sir, we are poor at the basics of Forex. So therefore put it in the YouTube. I am putting the basics in the YouTube itself. Okay, so please give a small comment whether you liked or whether did not like this, or whether the concept whatever is taught now on appreciation, do you know already or don't know, or whether you understood the concept that was discussed or not. Put one message if you really like it. Okay, please copy down the notes. Notes writing, please don't skip. It helps for years together to come. If you want to manage your treasury in a company, notes will be useful. You are not understanding the importance of our class notes. Write down.